Hello everyone, this is BHAVIK CHOKSHI here and I hope you guys are doing great. In today's video, we will do a full roundup for CA final AFM derivatives along with all the important sums covering futures, index futures, options, binomial, Black-Scholes, everything. So, hope this video is helpful. If you think such videos do help, please do press the like button before we start and let's proceed further into this important section. So we go to derivatives. This is one of the dreaded topics in your CA final AFM and in some cases rightly so. But hopefully if you are clear with some basics of derivatives and some standard concepts and rules, you should be good to go. So over here when you look at derivatives, first we try to understand on a theory level what does a derivative mean. A derivative has three essential features. First, it derives value from some underlying. This underlying can be currency, it can be a commodity, it can be a share, it can be a bond, it can be anything, but it derives value. Does not have its own value, it derives value. Second, the settlement will happen at a future date and not instantaneously. And third, the amount that you paid initially is nil or insignificant. Like in case of a forward, you pay nothing generally. In case of a future, you pay a deposit like a margin. In case of an option, you pay a premium, but in all cases, this is quite insignificant if you compare it with the overall value of the contract. So these are the features. The more common types of derivatives for which you get questions are forwards. Forwards are contracts between the entity and let us say another party, which is done over the counter, that is not through an exchange. Second is futures, similar to forwards, where settlement happens at a future date, an agreed price. However, these are exchange traded. So you might enter into a forward contract to buy dollars, let us say after 6 months, with the bank in case it is a forward, or you might enter it through an exchange like NSE, in which case it is a future. Future is inherently more liquid because you can trade on the exchange. Forward is much more customizable but less liquid. But both forwards and futures have this problem that they are two-sided, which means if you decide to buy the dollars at let us say 80, but the dollar comes to let us say 85, you're happy, you're getting a chance to buy it at 80. But if the dollar becomes 75, you still have to buy it at 80. And hence comes the option contracts, which is a contract where the option holder, let us say in case of an option like a call option where you have a right to buy, has an option to buy but not an obligation. So over here, if the price at which I'm getting a chance to buy, that is the strike price or exercise price, is 80 and the price becomes let us say 85, I would still buy it 80. But if the price becomes 75, I will let the option lapse and go in the market and buy it at 75 if I need the dollars. So will someone give you this option free of cost? No. So these options come with an attached cost, which is also called as a premium, which an option holder has to pay to an option writer. And in certain cases you have swaps. Swaps quite literally mean exchange. So you might exchange your commitments in order to sometimes reduce your transaction cost, etc. So these are the basic types of contracts. First, we'll start with futures. Within futures, from an exam perspective, I would say index future hedging is the most important. So if a sum comes, it is largely likely to be on index futures hedging, though we would study concepts like margins, stock futures, commodity futures, etc. as well. So over here, we have a summary regarding futures. There's something called as margin, which is a deposit. So over here, we'll do margin probably in some time. Then you have equity futures. Within equity futures, I would say the most important part over here is the index future hedging. So this part over here is the most important, but nevertheless. So when you look at futures, how do you find the theoretical futures price? Now, the theoretical futures price is calculated using what we call as a cost of carry model, using the concept of arbitrage. Like over here, if you were buying a share today whose price is 1000 rupees, then you will pay 1000 rupees, that is the spot price. And let us say there's a future contract where you get a chance to sell this, let us say at 1150. So will you enter into a future contract at 1150? Well, what should be theoretically the price of this contract? Well, it depends on the spot price. So let us say if the spot price is 1000, you are an arbitrager, you don't have money. So what will you do? Well, if you want to buy the share, you will probably borrow. And if you borrow, let us say at the rate of 10%, if the rate of interest is 10%, then you will say that spot price plus the cost of carry will come to 1000 plus 10% of 1000, that is 1100 after 1 year. However, the problem is if you had bought the share today and you thought that I'll sell it after 1 year, I don't know what the price would be, but if there's a future price which is quoting at 1150, then there is an arbitrage profit. Now, arbitrage profit means you have borrowed money, not invested anything, and you have entered into a contract where we are buying the share and then selling a future. So buying is called as long, selling is called as short. So you're long the share and short the future contract, in which case over here you are spending 1000 through borrowed money plus another 10%, that is 100 rupees of interest, and hence your cash outflow when you have to repay this loan would be 1100. However, if you were to sell the share, you will get probably 1150, and hence 50 rupees is an arbitrage profit. And if there is an arbitrage opportunity, there will be more and more people who will try to maybe short or sell the future contract, and demand supply tells you that more and more people who try to sell it, the price will keep on going down till the time it reaches 1100. Alternatively, if the price is less than 1100, then people would say that this future contract is available at a cheaper price in the future, and hence they will buy it. And probably in the spot market, you will take the opposite position. So you will say that, well, you know what, today the spot price is 1000, futures price is quoting at 1050. So theoretically, the price should be 1000 plus 10%, that is 1100, using the cost of carry model. However, the future is available at 1050, so we will buy. So if you buy in the futures market, then to cover the position as an arbitrager, you will sell in the spot market. So if you sell in the spot market, you will get immediately 1000 rupees, which you can deposit, earn interest at the rate of 10%, come to 1100. After 1 year, if you have entered into a future buy, you will pay 1050 out of it, get the share, close the position where you might have borrowed the share and sold, and make a 50 rupee profit. So again, these words might be slightly technical, but the simple way in which you can find the theoretical futures price using cost of carry model is the spot price plus what we call as a cost of carry. Now, how do you calculate the cost of carry? Typically, if nothing is given, we calculate it using simple interest principles and assume compounding happens on an annual basis. So if you are trying to find the theoretical futures price after 6 months, you will say that, okay, that is the spot price plus, so that is 1000 rupees plus 1000 into, let us say, 10% into 6 by 12. That's it, simple interest. So this is 1000 plus 1000 into 10% into 6 by 12. So there will be no compounding effects unless the question specifically tells you that compounding happens monthly, or compounding happens at monthly rest, etc., or quarterly. We will not take that, and hence this will probably come to 1050 over here. So the workings are very easy. Futures price is a spot price plus the cost of carry. The only challenge that I can foresee in such simple situations is in case there is dividend. So shares usually give you dividend, and if they give you dividend, the dividend is received by the spot holder, but it is not received by the future holder. So if you are trying to find the value of future contract, remember the spot price today is the present value of all the future cash flows, that is all the future dividends. However, a future contract holder who is buying the, or who is going along the futures contract, is going to probably get his hands on the share in the future, maybe after 6 or 12 months. But what if a dividend is received in that intermediate period? The today's spot price covers that, it includes that. However, a future holder is not going to be entitled to that, and as a result, while you calculate the theoretical futures price, you will take the spot price plus the cost of carry. However, you will subtract the dividend. Again, when you subtract the dividend, it is important to know what is the time when the dividend is received. So first of all, we try to understand why we need to subtract the dividend. The logic over here is the spot price includes the benefit for the dividend that is going to come, let us say, in the next 6 months or 1 year, as the case may be, whereas the future contract for 6 or 12 months will not include the benefit of that for that dividend. Other dividends it might include, and as a result, you will subtract the dividend, take the X dividend price. So over here, you will take spot technically minus dividend, that is the X dividend price, but you want to find the price in the future. So that is, you will take the spot price to a future date. So this is spot into 1 plus R into, let us say, M by 12. So let us say the contract is a 12-month contract, which means today's spot price of 1000, you will take it after 12 months to find the futures price, and hence this is S into 1 plus R by 12 minus a dividend, but when is the dividend received? Well, if the dividend is received after 6 months, the contract still has another 6 months to go. We want to take all the price to the future because you want the future price. So this dividend into 1 plus R into, let us say, T by 12. T is the time from the date the dividend is received till the time, let us say, the contract expires. So probably if it's a 12-month contract, this is 12 months, and if the dividend is received after 6 months, you will do minus 6 by 12. Now, there may be different formulas that institute uses at different places, and students sometimes do get confused over here that there are different formulas. Ideally, it is just a summation of the same formula. So sometimes what happens is dividend is received initially upfront, in which case over here this T is equal to M, and hence what institute sometimes does over here is it directly does this formula let us say if I were to take this with dividend, it directly does this formula of f is equal to s minus d into 1 plus r. Because the dividend is received immediately, even that will have a 12-month adjustment, even the spot price will have a 12-month adjustment, or sometimes what happens is the dividend is received at the end, in which case there is no separate time value adjustment to be done for the dividend. So this is s into 1 plus r into m by 12 minus d. That's it, directly. But if you by any means have a problem where you are unable to grasp what is the dividend to be taken, then what you will do is you will take this standard formula and apply this, and this will never go wrong. So just a second, if I have this handy. So this is your f is equal to s, time value adjusted, you take it up to the futures date, minus d, again time value adjusted, you take it up to the futures date. So this is the theoretical way in which you can find the futures price in case of a stock dividend or a stock futures case. Now what do you mean by stock futures? Well, let us say there is Reliance Industries Limited and you want to buy or sell the Reliance Industries share at a future date, and hence you enter into a stock future contract. However, you don't have a stock future for every share, and sometimes you might be holding so many shares, so to manage the risk you might have to enter into a lot of stock futures. And hence what is very popular in practice as well as in the exams is a concept of something called as index future. What do you mean by index future? Index future means if you look at, let us say, a stock index like a Nifty or a Sensex, that has a future. It is a basket of securities that has a future contract attached. Now what sometimes happens over here is there is a relationship between Reliance ka share as well as the Nifty, and that relationship is depicted by beta. So rather than me taking a separate stock future for Reliance, which is there in my portfolio, a separate stock future for a Tata Steel, which is there in my portfolio, and 20 other shares which may be there in my portfolio, I will try to find a portfolio beta for my entire portfolio, and then rather than taking a stock future to manage the risk of each of these stocks, if I want to manage the risk of the entire portfolio, like let us say elections are coming, I don't know what the election outcome would be, so I want to hedge, protect myself from the uncertainty till the time election results are out, in which case I want to protect my shares. So generally, if you want to protect, you have bought the shares. The strategy typically is, if you have bought the shares and you want to protect, then you will take the opposite position, that is you will sell the stock futures. Okay, I have bought it, I want an assured price at which I get, so I will sell. Or if you have entered into a short position, that is you have short sold the shares which you are planning to buy at a later date, you don't know at what price you can buy, and hence if you have shorted or sold the shares initially, the offsetting position will be going long or buying the same in the futures market to kind of protect yourself. So over here usually hedging happens, whether it is stock futures or index futures, by taking the offsetting position. So if you are going long a particular share, hedging happens by going short the share's respective stock future, or going short, let us say, equivalent Nifty futures. Okay, so the concept for stock futures and index futures is by and large the same, just that in case of a stock future, the underlying is the share itself. In the case of an index future, the underlying over here is the index. So an important point over here would be, how do you manage, how do you hedge in case of an index future? So for example, over here you are going long a share worth, let us say 100 lakh rupees. Let us say you have a portfolio with a beta of 2 and 100 lakh rupees worth of portfolio, where you want to protect yourself from, let us say, adverse movements over the next 3 months. So what do? You try to go to a similar portfolio which you can take an offsetting position, that is sell. So the strategy over here, so your original portfolio would be a long 100 lakh portfolio. Your hedging strategy would involve going short. Now you can either go short on the individual shares or you can go short on the index. So index future. Now the problem is, how many index futures should you go short on? So you can try to find the number of contracts. You will say that your portfolio is 100 lakhs. However, your portfolio has a sensitivity of 2 as compared to the index, and hence you will multiply this by the beta. Beta is 2 times. So it is basically the number of contracts will be your portfolio into the beta. So that will kind of show the sensitivity, and you divide this by the index future single lot. So what happens is, probably one lot of Nifty is worth 20,000 rupees. Let us say one lot of Nifty or one Nifty is, let us say, approximately 20,000 rupees, and in one Nifty there are 50, one contract there are 50 units of the Nifty. So this is 20,000 into 50, that is coming to around 10 lakhs. So this is 10 lakhs. So if I want to trade, maybe go long, go short, whatever, one Nifty future will comprise of 50, let's say, individual Nifties, and hence 10 lakh will be the lot size. So if I want to find the number of contracts, well, this is 100 lakhs into 2, that is 200 lakhs upon 10 lakhs. So that is 20 such contracts. So for hedging, I will go short 20 Nifty futures. Sir, but how will that protect yourself? Well, let us say if the stock price goes down by 10%, or let us say if the Nifty falls, let's put it the other way around, let us say the Nifty falls by 10%. If the Nifty falls by 10%, your stock, which has a beta of 2, should ideally fall by 20%, and hence you are staring at a 20%, that is 20 lakh loss on a 100 lakh portfolio. You are staring at a 20 lakh loss. Now, if you have shorted the Nifty futures, if you have shorted 20 contracts of the Nifty, when the Nifty was actually 20,000 rupees, you shorted, you sold, in which case, after, let us say, 3 months, if actually the Nifty falls by 10%, Nifty would have gone from 20,000 to, let us say, 18,000. A short Nifty future can be closed out by taking the opposite position. So if you have sold the Nifty futures, 3 months are done, you can call up the broker and say, okay, let us cover up, square off. These are technical terms, but let us say, this means let us close our position. So if you have originally sold, you will cover it up by buying the Nifty futures, but when you go to buy, the price is 18,000. So your selling price was 20 minus your cost price is 18, and hence you are sitting on a 2,000 gain per unit of Nifty, and in one contract there are 50 units of the Nifty. So on one contract you are gaining 1 lakh rupees, and you have 20 such contracts, and hence 20 lakhs is your gain, which offsets the loss on the underlying. So this is how Nifty futures mechanism works. So what you try to do is steps for index future hedging, and in my opinion this is what the institute usually asks. Strategy: you take the offsetting or the reverse position. So you first figure out your original contract, your underlying contract is a long position or a short position. Usually you have a long portfolio that you have. The hedging in case of a long portfolio will be the opposite. So you will short the Nifty contract. Second, maturity. Well, there may be various options which are available. Ideally, you will take the contract that covers your maturity and it is nearest to your maturity. So for example, if you want to protect yourself from the risk over the next 3 months, and you have a contract which is only for a 1 month, you have a contract which is for 4 months, and you have a contract for 7 months. If these are 3 options and you want protection for only 3 months, you will take the 4-month contract which covers your maturity and is closest to your maturity. The 1-month contract will keep you exposed beyond that 1 month for the other 2 months. The 7-month contracts will unnecessarily change due to the expected price movements over 7 months. However, you need price protection for only those 3 months. So the nearest, ideally would love to have the 3-month contract, but if that is not available, the nearest over here would be the 4-month contract. So maturity which covers our horizon and is closest to our horizon. The number of contracts over here will be the equity portfolio. In our example, 100 lakhs into the beta, let us say of 2 times upon the contract size, which is the futures price into the number of Nifty contracts. We'll do practice for these sums as well because these are very important. If the answer is in decimal, we take it to the nearest number. Having said that, there have been cases where they've rounded off to the higher number, lower number, whatever. But generally, if nothing is given, we take it to the nearest number. Now, at settlement, if you want to find a gain or loss, as we saw that the gain or loss on our underlying portfolio was 100 lakhs into 20%, that is a 20 lakh loss. And the gain or loss on futures will be the selling price, that is probably 20,000 at which you sold, minus 18,000 at which you buy, into the number of Nifty contracts, into the price per contract, and that will give you the ultimate gain over here. Okay, so this is regarding index futures hedging. The only challenge that can come in index futures, like in case of stock futures, is the possibility of a dividend. But the adjustment for dividend is quite different when we come to stock futures as well as index futures, because in case of a stock future, the dividend is a percentage of the face value of that stock. So in a stock future question, if a question comes and they say that, okay, dividend is, let us say, 25%. If nothing is going, that is 25% of the face value. However, index does not have a face value, and hence if the question tells you that on the index, maybe Nifty has 50 shares, there's a dividend of, let us say, 10%, that is a percentage of the market price. Why? Because index does not have a face value, so the dividend percentage, unless given otherwise, for a stock future will be a percentage of the face value, but index future will be a percentage of the market price. Similarly, stock future usually gives dividend as on a date, because the stock gives dividend on a particular date, but when you have a basket of 50 stocks, they can give you dividends at different points of time. Hence, usually an index future dividend percentage is a percentage per annum number. So when you look at this, the summary of differences between stock and index future: stock future is a percentage of face value, index future is usually a percentage of market price. Stock future is usually a flat percent, it is as on a date, whereas index future is a percentage per annum, and hence your working slightly differ. So like R is the rate of interest that you have to pay, D is the dividend yield in percentage that you receive. In case of a stock future, you calculate D in rupees and then subtract the D. However, in case of an index future, what does happen is, you would kind of say that, well, in case of an index future, you will have, if you want to find the theoretical futures price of an index future, you will say, okay, spot price of the Nifty is 20,000 into 1 plus R into M by 12. Okay. But can the constituents of Nifty also give me a dividend? Well, yes. In that case, do I need to deduct the dividend? Well, yes, and hence minus D. However, this is, when I say minus D, this D is not coming at a particular date. This D is also a percentage. This D is also a percentage of the spot price, and it is arising over the period. So you'll say, okay, that is minus S into D into again the time period M by 12. So basically, if I were to do this working, then I can take, if I open these brackets, this is S plus S into R into M by 12 minus S into D into M by 12. So if I take this S into M by 12 common, over here my workings would be S plus, you will have S into R minus D into M by 12. And if I again take S common, this is nothing but the standard formula that you get is S into 1 plus, instead of R, we will have R minus D into M by 12. So this is your usual formula that you will apply in all cases where the dividend rate is a percentage per annum rate and based on the market price. Usually in stock futures, dividend is a percentage of the face value and not the market price, and it is not a percentage per annum value, it is a dividend to be received as on a particular date. So this is your usual formula that you will use. So I hope you are broadly clear with this. Another challenge that can come sometimes is what happens in case there is continuous compounding. Let it be stock futures, let it be index futures. What happens if the compounding happens continuously? In which case, mathematically, we have just given a summary over here that, well, usually we assume that the compounding happens annually. So this is the formula. If the compounding were to happen annually, it is usual compound interest formula that A is equal to P into 1 plus R raised to N, or F, that is a future value, is equal to S, that is a spot value, into 1 plus R raised to N. However, if it is half yearly, then R divided by 2 into N by 2. If it is quarterly, R divided by 4 into N by 4. Monthly, divided by 12 into 12, and so on. However, if it is continuous, your time interval is very difficult to quantify, and as a result, we use some principles of limits and tendencies that you might have studied in earlier mathematical days, and we come to a summarized formula which is F is equal to S into E raised to Rn. This is to be done if and only if the question tells you that there is a continuous compounding, or it gives you a E raised to some value in the question. The only place where you necessarily have to do this working is Black and Scholes when you do your option valuation, but otherwise this will be applied only if the question tells you continuous compounding or it gives you a E raised to some value in the question, like what was even given in the November 23 exam question. Okay, so over here, sir, what if there is a dividend? If there is a dividend, your formula will be F is equal to S into E. We will assume that like the rate of interest time value is compounded continuously, the dividend is also continuously compounded, so you will have R minus D into N. So over here, if you look at dividend, long story short, dividend has to be deducted. In case of a stock future simple question, you will deduct the dividend and then do time value adjustment if required. In case of an index future, again you will deduct, but you deduct the rate of dividend. And in case of continuous compounding, wherever applicable as well, again this will be F is equal to S into e raised to R minus D into N. Now, apparently these might all appear to be different formulas, and if you try to remember each of them separately, might get intimidating. However, if you just remember this basic principle that, okay, the future value is the price in the future, so you have to take the spot price to the future by adding the interest rate, cost of carry. However, during that time period, you might even as a spot buyer get dividend, which a futures buyer will not get, and hence a future buyer will not consider that, and it will deduct the value of dividend. If dividend is in rupees, you directly deduct the dividend, do a time value adjustment separately. If dividend is a rate, then you do R minus D, and wherever there is R, you have a R minus D, and you solve accordingly. As long as it is a rate, which is a percentage per annum rate, and a percentage of the price, which is also called as dividend yield. A bit of practice will really help over here. Sometimes you might need to find the value of log and anti-log. There are various ways in which you can find that. One of the ways can be you will take the number on your screen, on your calculator, square root it, let us say 19 times. Then being log, you will subtract 1 and then multiply it by 227695. Whatever number you get is the log value. Make certain adjustments. Then you will want to find the anti-log, in which case you will divide, take the opposite steps, divide by 227695, add 1 and then do into equal to, that is squaring for 19 times. Some students prefer this, some students have another method that they take 12 as a base, some students take 15 as a base and do it. You can do it using any method, your answers will be approximately the same and they are very well accepted. You don't necessarily need to refer the log tables. For this, usually institute should give you, but if not, you can use your calculators to find the log values, which will be helpful especially in cases like continuous compounding, where you have to find the e raised to Rn type of values. Two other things. So this was, in my opinion, the most important part of the futures discussion, the index future hedging, and we'll do two important sums on this in some time before we start the option section. First, we will finish off two other concepts which are there in futures as well. One is commodity futures and one is margins. So when we look at commodity futures, a special feature of a commodity is that the commodity does not give me any dividend, and hence there is no minus D over here. However, a commodity has to be stored, and hence there would be a storage cost. So if I am a spot buyer and if I decide to buy, let's say 100 kilograms of sugar today and decide to sell it after 1 year, I have to store that 100 kilograms of sugar somewhere, and as a result there would be a storage cost attached. So a spot buyer will have to pay money to buy the shares, or not shares but the commodity in the spot market, but he or she will also have to pay for the storage cost, and hence you will add the storage cost. Again, you want to find the futures price, so you will take everything at the future. So spot plus the interest adjustment, storage cost if it is incurred during that period, again plus the interest adjustment. However, what happens is some of the commodities may have utility. So for that 1 year, when you have that commodity, you can possibly use it and generate some value, like shares can give you dividend, that is the utility of a share. Different commodities can give you different utilities, and as a result over here, if the commodity gives you some value, then there would be something called as convenience yield, which is an income or a value. Like if you were to take a property and you decide to forward sell it after 2 years, that property can actually give you rental yield over those 2 years, and as a result, that is a convenience. That is the convenience of holding the property in the spot market and then deciding to sell it after 2 years. But if you sell it after 2 years, someone buys it, that person is not going to get the rent of these first 2 years, but you are going to get it, and hence we can subtract, let us say, for example, the convenience yield. Usually convenience yield will be either given in the question, or you can calculate it as a balancing figure, provided the futures price was given, spot price is given, rate of interest is given, and storage cost can also be inferred. So over here you will have commodity futures. The theoretical futures price will be the spot price plus the cost of carry, that is the interest, plus the storage cost minus the convenience yield, if any. Sometimes the question might ask you that what is the hedge ratio between the spot commodity like copper that you have bought and a copper future. Like a copper future is like an index future, considering various grades of copper, and hence you can try to find the beta. So the hedge ratio over here can be calculated as a beta. Like how many times, like in the example we did, we found beta of 2 in that example, where we said by no matter how much is the underlying portfolio, twice of that will be the hedge required. In a similar way over here, you can try to find the beta which represents the hedge ratio. The formula over here is the same as the formula that is there for beta. Okay, number of contracts is again portfolio into the beta upon the futures contract size, like we discussed earlier. So that is regarding commodity futures, not as important from an exam perspective, but has that additional layer of complexity for storage cost as well as convenience yield. Next, we have margins. Margins is applicable only in case of futures. It is not applicable for forwards because they are one-to-one contract. So in futures, there needs to be a deposit that you need to pay. Why? Because the futures contract are exchange traded. Now, if you have traded on the exchange, you know that if you buy anything on the exchange, you don't know who the counterparty is. But for a valid contract to exist, you should know who the counterparty is. So what happens in an actual trade is, if you are buying, someone else is selling, but there is NSE in the middle. So the clearing house of the NSE breaks the contract into two, and it says that you are buying from the clearing house of the NSE, so you don't have any counterparty risk. If the other party does not fulfill their share of the obligation, the NSE would. Same is the case, the other party's contract would again be split, where the NSE would kind of break this contract and commit to fulfill the obligations to the other party as well. So NSE over here acts as a counterparty. Now, why would NSE take such a risk? Well, because it's an exchange and it is its business, but it is taking a risk that what if the other party does not fulfill the contracts, and hence to mitigate that risk position, the NSE usually demands margins from both the seller as well as the buyer. Now, margin is a deposit. Initially, the margin is calculated. Sometimes it is calculated using the concept of VAR, value at risk. Otherwise, if nothing is given, at least in the derivatives chapter, the sums that have come, well, the initial margin is calculated as the average daily absolute change. So, for example, if there's a contract, on an average, what is the average daily absolute change? Plus 3 times the standard deviation of these absolute changes. So, for example, if the average daily absolute change is 10,000, I will require a 10,000 deposit at least, plus 3 into the deviation. Maybe it is 10,000 is average, maybe it can go plus or minus, the deviation is 2,000, so 3 times that. So this is 3 into 2,000, and hence 16,000 can be taken as the initial margin. So I will have to deposit the 16,000 for a futures contract. But is it possible that this margin was based on today's position? It is possible that the share price changes. If the share price changes and if you are getting a gain, the exchange will do a mark to market settlement. This is called as mark to market settlement. It will assume that if you have bought a futures contract at 100 rupees and the price at the end of the day becomes 105 rupees, that means you have gained 5 rupees. Rather than waiting for the expiry, the exchange will give you 5 rupees today only. Okay, or if the share goes from 100 to, let us say, 95, and if you have bought at 100, then you have lost 5 rupees, in which case the exchange says that theoretically if I were to settle today, you have to pay me 5 rupees, so you will have to pay that 5. So either you pay that 5 directly, or in most cases the exchange will adjust that 5 from the margin account. So they will reduce, let's say this contract was for 100 shares, so 100 into 5 is the loss per share, so 500 rupees, so 16,000 minus 500, that is 15,500 will be there in your margin account. So do I have to refill this 500? Well, they will give you usually a level which is 70 to 80%, which is called as maintenance margin. So which means if you take 16,000 and let us say 70% is a maintenance margin, so 16,000 into 70% comes to 11,200, which means if your margin account balance falls below 11,200, then a margin call will be triggered and you will have to deposit the shortfall to take it all the way up to the initial margin. So let us say on the next day the price of the share falls hypothetically from 95 rupees to, let us say, for example, 80 rupees. So that is a loss of 15 rupees per share into 100 such shares, and hence there is a loss of 1500 rupees, and this can keep on going till the time if the price goes below, let us say, for example, if the price over here goes below the a particular level and the margin balance falls below 11,200, it becomes 11,000, then a margin call will be triggered and you will have to pay the entire, not just up to 11,200, you have to go all the way up to 16,000. This is called as margin account. There are a couple of questions on margin which you can try. If it comes, it will be a fairly direct question. This is how you calculate the initial margin. Maintenance margin is usually 70 to 80% of the initial margin. So there are a couple of questions on that which you can possibly attempt. So that largely takes care of the section of futures. What we'll try to do is we'll try to do 2 sums on index futures hedging over here. So if you go over here, we'll try to discuss a few questions. Let us say go to question on. Okay, so let us review this. question number 3. This is we are discussing a few of our questions from the Super 90 file that we kind of shared. So these are the relevant questions from these topics that I want to cover with you separately. So if I look at question 3 over here, BSc price is 5,000. They have not told you whether this is BSc spot price or BSc future price. If nothing is given, this is like the BSc spot price. The value of portfolio is 10,10,000. So unless given otherwise, we will assume that you are going long the portfolio. So the value is 10,10,000. Risk-free rate of interest is 9% per annum. This is R, and the dividend yield is on the index is 6% per annum. It is clearly given it is per annum and it is given yield, but even if it is not, usually on the index it is always a dividend yield, that is a percentage of the price, and on a per annum basis. The beta of the portfolio over here is 1.5. Okay, so this is the given data. We assume that a futures contract on the BSE index is available for 4 months maturity, is used to hedge the value of the portfolio over the next 3 months. Now ideally, if you want to hedge for the next 3 months, you should take a position, a contract for 3 months only. However, here you have been given for 4 months. Okay, one futures contract is for delivery of 50 times the index. Based on the above information, calculate the price of the futures contract and the gain on the short futures position if the index turns out to be 4,500 in 3 months. So there are two things over here. First, you want to find the price of the futures contract. A lot of students would have said that 5,000 is a price. That is a spot price. So over here, if you want to find the price of the futures contract, remember your futures contract is a 4-month futures contract. You might want hedging for only 3 months, but the exchange does not have a 3-month contract. So the pricing will be based on the 4-month contract. So this is F is equal to S. What is the spot price? 5,000 into, over here there's nothing given to show that it is continuous compounded. So this is into 1 plus R minus D. So rate of interest over here is 0.09 minus D, that is 0.06 into, let us say, 4 by 12. This is a possible mistake that you can make, and hence this is going to give you, I think, 5050. So this is, I think, 5050. This is your futures price. Now once you have the futures price, you want to hedge. So over here, if you're long the portfolio, the strategy over here should be to short the BSE futures, 4-month BSE futures. You will want to short the 4-month BSE futures. The second question is, how many contracts should you kind of short? We will try to short the number of contracts in such a way that your portfolio gets covered. That is 10,10,000 is my portfolio into the beta. The beta over here is 1.5 upon the contract size. Well, one futures contract, well, one unit is 5050 into 50. So this is 5050 into 50. 5050 into 50 comes to what? 2,52,500. So over here you'll have 252,500, and hence this is 10,10,000 into 1.5 upon 252,500. So this is what? This is going to give me 6 contracts. So my position will be, I will try to short 6 4-month Nifty futures contract to hedge this position. The second part says the gain on the short futures position if the index actually turns out to be 4,500 in 3 months. Remember, it says that the index turns out to be 4,500. The index over here is 4,500 after 3 months, but it is a 4-month contract, and hence there's still 1 more month remaining. You have entered into a contract which is a short futures contract. So you have sold the futures at the rate 5050. To cancel it out, you will have to buy the futures. So at what price will you buy? Well, the futures price prevailing in the exchange. So over here, what will be the futures price if I were to go to see, let's say after 3 months, there's still 1 month remaining on the futures contract, and hence this is going to be 4,500 into 1 plus 0.09 minus 0.06 into 1 by 12. So this is 1 month remaining. So this is 4,500 into 0.03 divided by 12. So this comes to probably 4511 point something. I think 4511.25. So if I've originally sold, I will cover the contract by buying. So if I want to find the gain or loss, actually I will say that the gain or loss over here is the selling price. I've agreed to sell at 5050, and now if I don't need it, I'll buy it at 4511.25. This is for 1 unit into every contract has 50 units, and you have entered into a contract for 6 such contracts, and hence 5050 minus 4511.25 into 50 into 6. So this comes to what? 161 625. So this is 161 625. This is your gain coming from question number 3 over here from the important questions file. You go to question number 4, which is also on similar lines. So if you go to see on 1st of April 2015, an investor has a portfolio consisting of 8 securities as shown below. So this is also an index futures hedging. There are a few other adjustments that we need to do. So this is, let us say, market price into number of shares, and you have the beta value. So basically, what are we supposed to do? The cost of capital for the investor is 20%. This time around the question says continuously compounded. So over here, you'll probably learn the continuous compounded method. The interest, the investor fears a fall in prices of the shares in the near future. Okay. Accordingly, approaches you for advice to protect the interest of his portfolio. You can make use of the following information. So the current Nifty value is 8,500. So this is your spot Nifty, and the Nifty futures can be traded in the units of 25 only. Okay. Futures for Nifty are currently quoted at 8,700 and June are quoted at 8,850. So you have been given 2 future actual prices, and you are required to calculate the beta of the portfolio. Now this is a portfolio beta application. Portfolio beta is calculated as the weighted average beta, where the amount invested in each security is taken as a weight. So over here, the amount invested in A is taken, for example, as 29.4 into 400 and so on. You find the amount invested in all of these securities. That will give you an overall portfolio value of 9,94,450, and to that you will take the beta value for these individual items. You will take the beta value. So you will have various beta values, and we will find the weighted average beta. So this will be your weighted average beta. Now when we want to find the beta of the portfolio, this is 1.1018 for example. Now the second says calculate the theoretical value of the futures contract for contracts expiring both in May and in June, and we are given the e raised to 0.03, 0.04 and 0.05 values. Now let us say if I were to take the June contract as a base, I will say the June contract will be the futures is equal to the spot, which is 8,500 into 1 plus usually R, that is 20%, into let us say 3 by 12. Today you are sitting on 1st of April, so June contract may be 3 months away. However, we have been clearly given that this is continuous compounded, and hence this is equal to S into e raised to Rn. So what is e raised to R? So this is 0.20 into 3 by 12. So this is going to be 8,500 into e raised to 0.05. And is that e raised to 0.05 given? Well, yes, it is given to us as I think 1.5127. So this is 8,500 into 1.05127, and you will get the answer 8,500 into 1.05127, which is 8935.80. This is 8935.80. So this will be giving you your theoretical futures price for the June contract. Similarly, if you try to do for the May contract, you will find that for the May contract, your value comes to 8,500 into e raised to 0.03333. You will do that working, but again, you have e raised to 0.04, e raised to 0.03. You can use interpolation and find the value if you have to find the theoretical value. Now, the last part says the number of Nifty contracts that he would have to sell if in each of the following cases he wants to hedge his entire portfolio, 50% of the portfolio, or let us say 120% of the portfolio. So you need to find the number of contracts. So how will you find the number of contracts? Well, you will first take the portfolio value, which is 994, I think 994,450, and to this you will multiply, let us say, the beta. So if you were to multiply, let us say, the beta over here, for example, is 1.1018, and you divide this by the number of contracts. Now, while you are dividing this by the number of contracts, your contract size will be, in each contract, your actual futures price is 8,500 for the June contract. You want to hedge for June, so May is irrelevant. And your theoretical price is 8,935. Which one will you take? Well, when you do the actual deal has to happen at 8,500 only. 8,850 only. The actual price into 25. 8850 into 25, this comes to 250. So this is basically 994,450 into 1.1018 divided by 250, which comes to what? 4.95 contracts. That is approximately 5. Now this is if I want to hedge the entire portfolio. If I want to hedge 50% of the portfolio, over here I'll multiply by 50%. If I want to hedge 120% of the portfolio, I'll multiply it by 120%. So over here you can accordingly find, let us say in this particular case, 5 contracts and then 2 or 6 contracts as the case may be. So this kind of takes care of the discussion on futures, along with, I would say, 2 of the more important questions which pertains to the futures. Next you go to the section of options. So the second part of this chapter focuses on the part of options. Now within options you need to know some basic terminology and the coverage within this section. So this section has 4 parts. First would involve basic option payoffs, which is easy, at the same time scoring. Second would involve certain option strategies which are not very important from an exam perspective, but it is good if you know a few strategies. Third is option valuation, which is arguably the most important part in the option section, like index future hedging is the most important part in futures. And fourth is option Greeks, which is probably relevant from a theory or an MCQ perspective. Lesser chances of that coming in the exam. So out of these 4 parts, I would say the option payoff, that is the option return, and the option valuation are the 2 most important parts. So first, before we proceed, we just kind of brush up our understanding of a few key terms. Options refer to rights but not obligations to enter into a contract. Call option is a right to buy, will be exercised if the spot at expiry is greater than the exercise price. So it makes sense kind of taking the price, it makes sense kind of doing a lower value buy then a higher value buy. So spot at expiry should be greater than the exercise price in order to exercise the call option. And then you have put option. Put option is a right to sell. You put a product and it gets kind of taken away, so that is a right to sell, and hence this option will be exercised if spot at expiry is lower than the exercise price. That is, people would love to sell at a higher exercise price, so put option gets exercised when the exercise price is higher. People would love to buy at a lower exercise price. Call option gets exercised if the exercise price is lower. This might sound very easy and obvious when you hear it. However, you have to be very careful when you kind of sit to apply it, because in case of an option, there are 2 parties. There's an option holder as well as an option writer. An option holder is almost always considered to be long the option, that is buying the option. An option holder is long the option, whereas the option writer is considered to be short, or an entity which sells the option. So whether the option is exercised or not, whether call option is exercised or not, depends on whether you are an option holder only. So even if you are an option writer, you do not have the choice of exercising. You have to think that what will the holder do in such a case. If the holder exercises, then the holder will get, let us say, some return which is called as payoff. Payoff is the difference between the spot and the exercise price. And if the holder lets the option lapse, there would be no payoff. So the option holder does not get anything, option writer does not receive, does not pay anything. So just to kind of quickly summarize, when you look at a call option, it's a right to buy, will be exercised when the spot at expiry is greater than the exercise price. So people love to buy at a cheaper rate, and hence exercise price should be lower. Put option is a right to sell and would be exercised if the exercise price is greater. For an option holder, the payoff, how do you calculate the payoff? The difference between spot and the exercise price in case of call option, or the difference between exercise price and spot in case of a put option. Payoff would arise in case of in case the holder decides to exercise. The payoff will be positive for an option holder. It will be negative because the option writer has to pay, negative for an option writer. So over here, call option will be pay SX minus XP, put option will be XP minus SX. SX over here is strike price. Sorry, SX is the spotted expiry, and XP over here is the exercise price, or also called as the strike price. Now, when you look at net payoff is the difference between the payoff minus the premium. While calculating net payoff, you should not, and even the institute does not, do any separate time value adjustment. So over here, your net payoff is directly your total payoff minus the premium if you are an option holder, or it will be payoff plus the option premium in case of a writer. In case of a writer, the payoff can be negative or it can be 0. In case of a holder, the payoff can be positive or it can be 0. Net payoff for either of these parties can be positive, 0 or even negative, because after the premium, the amount may even turn to be negative even for the holder. So over here, there are two types of options. One is called as a European option, which can be exercised at expiry only. However, you can trade, buy or sell that option on the exchange even before that. Second is the American option, which can be exercised at any time, at or even before expiry, which can also be traded on the exchange. So in a way, an American option is very similar to an open-ended mutual fund, which can be, let us say, exited by redeeming at any point, whereas an European option is very similar to a closed-ended mutual fund, where which it has a maturity, but you can always buy and sell on the exchange. Then you have three key terms which are linked to options in the money. That is, if the option is likely to be exercised. In case of call option, spot greater than expiry, exercise price. Out of the money, where the option is unlikely to be exercised, and at the money, where you are indifferent, where the spot at expiry and the exercise price, let us say, are equal. That is called as an option, which is at the money. So these are key terms. Broadly, I think you should be aware, but otherwise it should be manageable. So over here you have the first part, where if you have to kind of find the option payoff, there can be problems linked to the calculation or finding of option payoff. Second is option strategies. I would not really put a lot of weight behind the option strategy working. In fact, if you open the institute material, you don't really see a separate theory section for that, and hence it is not as important. However, past questions have used words like straddle, for example, so you should broadly know what these strategies are. Like, there can be combination strategies where you try to combine a call and put. This can be something called as a straddle. Okay, before that you have two types over here. One is a basic primary strategy. Like, a call option is more like a bullish option. So if you are buying the call option, you expect the price to go up, and hence you are buying the call option. So if you have a bullish outlook, ideally you can take only the call option. If you have a bearish outlook, so put option is the right to sell, and if you are expecting the price to go down, that is when you take the put option. So if you have a bearish outlook, then put option is the right option for you. But if you are a little unsure, then you can look at combination strategies like a straddle. Straddle involves one call and one put at the same exercise price, same time. Or a strip, where you have more possibilities of a price falling, so you buy one call but two puts. A strap, which is buy two calls, one put, and then there is a strangle, where you are buying one call and one put, but at different exercise prices or different time frames. So basically, if you are broadly aware of this, this is enough. Similarly, there can be other strategies like a spread strategy, where you can just look at calls. So you can buy a call at a lower exercise price, sell a call at a higher exercise price, or vice versa. Or you can have strategies like a butterfly strategy, where you can buy two calls at the upper and the lower limit and sell a call at the middle item. So just have a broad understanding. Do not really rack your brains a lot behind this, and it should suffice. Then comes the most important part, which I would reckon in the option valuation section, which is option valuation. So when you look at three ways in which you can value an option, first is something called as an intrinsic value. Under the intrinsic value method, what you do is, typically the option valuation is like premium valuation. How much premium should I pay for the purpose of an option today is the option valuation. So usually the premium should be dependent on how much payoff I get, but payoff I will get at expiry, I do not know what the price would be at expiry, but I know what the price is going to be today. So in intrinsic value working, you will take the price today. So you will take, let us say, in case of a theoretical model or intrinsic value model, if I want to do the valuation of a call from a holder's perspective, I will say the price today is S0 minus exercise price. So this would be your payoff if today's price prevails. But even if today's price prevails, this exercise price is going to be paid, let us say, in the future, and hence rather than taking XP directly, we take the present value of XP. Why? Because, well, the premium has to be paid today, but the exercise price will be paid in the future. So if you want to do the valuation in today's terms, you will have to bring exercise price back into today's terms. The spot price is already in today's terms, and hence this will be the call option. Put option over here will be the other way around. You will take XP minus S0. Over here you are taking S0, that is spot today, and not SX, that is spot at expiry, because you don't know, you are a layman, you don't know what the spot will be at exercise price. So let us do the valuation based on today's spot. But again, even if it is a put option, it's a right to sell. If you will sell, you will get money, but this money you will get in the future, and hence we will have to take the present value of exercise price. So over here we will take the present value of the exercise price minus S0. The answer to this, if either of these case, if it is positive, that is the option premium that you are ready to pay. If it is negative, there will be zero value of the option. Option value, remember, cannot be negative. Your premium can be paid by the holder to the writer, or there would be no premium. There is no concept of a negative premium over here. So the workings are fairly easy over here. So you will have C0 and P0 valuation. It is just spot minus exercise price. But rather than taking the exercise price directly, we take the present value of the exercise price. Okay. Next, you have something called as the binomial option value. So this is a second method, a fairly more popular method. So when you look at binomial model, what does the word binomial mean? It means that at a future date, the share can take one of the two possible prices. But then why do I even need to go to a future date? I need to go to a future date primarily because the valuation as per intrinsic value or theoretical option value is based on today's spot price. However, the payoff will happen based on the actual price at expiry. I don't know what the price is, but I can actually make some estimates. How many estimates? Well, there can be many estimates. However, as per the binomial model, you can take one of the two estimates. Either the price goes up, let's say SU, that is a spot price if it goes up, or the price goes down, let's say SD, where the price probably were to go down. In this particular case, the price can possibly go up and go down. Again, you might have time intervals of 2 years and you can divide into two charts of 1 year each, or you can have a time interval of 2 years divided into 4 separate workings of 6 months each. Institutes workings usually maximum max out at a 2-year time frame. So usually for your binomial option valuation, the first step, there are multiple methods in which the binomial option valuation can be done, but the two most popular methods which the institute uses is something like the risk-less hedge method, also called as loosely the binomial model by the institute, or the risk-neutral probability method, which is in my opinion the much more easier and the method that you should go to if nothing is given in the question, where you have to estimate the probabilities. There can be various other methods like a replicating portfolio, etc., but these are the two essential methods that we will try to focus on, the risk-less hedge as well as the risk-neutral probability approach. So binomial in a way is best understood if you try to do it with, let us say, a numerical setup. So over here, let us say you have a share whose current spot price is, for example, 50. The price can possibly go up or the price can possibly go down. So you prepare a binomial tree. The exercise price of this is, let us say, 40. The price, if it goes up, let's say SU, if at the upper level is, for example, if it goes up, it will go up to, let's say, 70. If it goes down, SD, it will go down to, let us say, 30. Now, how do you calculate it? Probably you do something like standard deviation, volatility, and use that and find this. Let us say the rate of interest prevailing is 10% and the term is, let us say, 1 year for simplicity. Now, you want to find that how much premium should we be willing to pay. A theoretical option value would have said that S0, that is 50, minus the present value of 40, and whatever the difference comes should be the premium. However, the share price may not necessarily be 50 after a year. Well, by the way, it can be 70, it can be 30, but if it is 70, the call option will be valuable. It will give me a right to buy a share which is worth 70 at only 40 rupees, and hence 30 rupees will be my option value at the end of 1 year. Or if the price goes down, well, I get a chance to buy something at 40. However, if in the market it is available at 30, the option carries a 0 value. So how do I find the option value C0 today? Now, there are two ways in which you can solve this. One is a little more complicated, which is called as a risk-less hedge approach. Another is called, this method is sometimes also called as a delta hedging portfolio method as well. And second method over here is something which is called as a risk-neutral probability. So over here, there is also something called as a replicating portfolio approach, but for the time being, you will keep that aside. Institute study material gives you these two methods. Even replicating portfolio you can very well apply. There have been a some or two which have come in the past pertaining to the replicating portfolio, but most of the institute's theory and some pertain to these two methods. So let us kind of focus more on these two methods. So what does a riskless hedge mean? Well, you make a portfolio. Under this method, it says that you will make a portfolio, well, comprising of what? Well, shares. How many shares? Well, we don't know. Let us say X number of shares. You will go long X number of shares for every call option that you short. So over here, let us say you were to short a call option C0. If you were to short a call option, you will receive the premium. We don't know how much premium would be. However, This method says that you create a portfolio in such a way that your position is hedged, which means no matter what the share price is, whether it is 70 or it is 30, it does not really matter to you. Your portfolio, let us say, position is hedged. That is the entire essence of this method. So over here, if your portfolio comprises of X number of shares and let us say a call option which you have shorted, when you buy X number of shares, you will have to pay money. So that is your cash outflow. And when you short a call option, you will get a premium. That is your cash inflow. So initially at point 0, what will be your position? We will say that if you go to the market and you buy the share, every share will cost you 50. 50 into X is the amount that you will have to invest. That's a cash outflow. In return, you will get C0. That is the money that you will get if I were to short and receive on selling the call option. Now, after 1 year, what will happen? There are two possibilities as per the binomial model. The first possibility is the share price becomes 70. So, this will be 70x. The value of your long position will be 70x. However, you have shorted the call. If you have shorted the call, someone else has bought the call, and for them, for the holder, the option is in the money. So, they will exercise it, in which case you will have to pay. How much will I have to pay? Well, 30 rupees. I must have taken the premium, but against that, if the option has to be exercised, I'll have to pay, and hence I'll have to pay 30 rupees. At the same time, at the second instant, the price may turn out to be 30 and hence 30x. However, in this case, the option will lapse and hence you don't have to separately pay any premium. And as a result, over here, these are the possibilities after 1 year. But because your portfolio position is hedged, these two possibilities will give you an equal answer, because after 1 year, whether the price becomes 70 or the price becomes 30, if you have created a hedged portfolio, it will have no separate outcome. It will have the same outcome. So what do you do? Well, we will come to a particular value, but we'll do it slightly longer. So this is 70x minus 30x equals, I think this must be what? Yes, this must be 30 minus 0. Now, ideally, you can solve for x directly and get the answer. However, in the institute's material, there is a formula given to find x directly. So, if you don't want to do all of this and you want to directly bypass, so over here, x you can easily say 40x is equal to 30, and accordingly, you can find, I think, 0.75 or so, which will be x. Alternatively, what is 70? Well, 70 is SU, spot price at the upper level. 30 is SD, spot price at the lower level. 30 over here is a call option at the upper level, and 0 is a call option value at the lower level. I'm just trying to reconcile with the institute's formula. If some students kind of want to have a logic for that formula, so over here, okay, so we'll say into x over here. So if I were to take x common, x into SU minus SD equals CU minus CD, and therefore x can directly be derived. We do not derive this directly, we do the working slightly longer, but it can directly be derived by CU minus CD and SU minus SD. So rather than doing all of these workings, you can directly get this answer for x. Therefore x can equal, like you did earlier, okay. So over here, without doing all of this, if you did not do all of this, this is an unnecessary derivation for the timing. This is what, 40x equals 30. Therefore x equals, I think, 0.75. This x is sometimes called by the institute as a delta. What does this represent? It represents the number of shares for every call option sold. So for example, if you're selling 100 call options, you should go long 75 shares. That is like the delta. And hence, if I do this working directly, this is CU minus CD. So this probably comes to, if I'm not wrong, 30 minus 0 upon 70 minus 30, which will again come to 0.75, which can be directly calculated. So this is your extra possibility in case you want to exactly do what the institute does in these cases. Okay. If not, if you have x, then what do you do with this x over here? We will say that, okay, after 1 year, what will be the position? After 1 year, you will have, in case A, 70x, so 70 into 0.75 minus 30. So this is probably 70 into 0.75 minus 30. So this comes to, let's say, 22.5. So your portfolio in the position 1 will be 22.5, or you don't need to do both. But even in the second case, which is an easier case, your portfolio will be 30x. So 30 into 0.75 minus 0, which will be 22.5. Well, it is the same. Well, it has to be the same because it was a hedged portfolio, and hence it has to be the same, that is 22.5. Now if it is 22.5, this is 22.5 after 1 year. So we know that if we invest a particular amount today, well, the amount that you are going to invest today is going to be 50x minus C0. That amount is necessarily going to become 22.5 after 1 year. Therefore, the present value of 22.5 will equal 22.5 upon 1.10. This is probably equal to 20.45. Let's say this is 20.45. So today I know that I'm investing 50x minus C0, which is actually 20.45, because 20.45 today will become 22.5 after 1 year. And as a result, over here 50 into 0.75, it's a riskless hedge, and hence on 20.45 investment you will earn a risk-free rate of return that is equal to 10%. In binomial, you should take the risk-free rate of return. So this is equals to 20.45, and hence if I go to see, this is what 50 into 0.75 comes to 37.5, and 37.5 minus 20.45 equals C0. Therefore, minus 20.45, which will come to 17.05. So this is C0 equals 17.05. This is the premium that you should be prepared to pay under the binomial option value. This is the method that you will follow if the question says that you have to follow using a riskless hedge approach, or the question says you need to find using a delta hedged portfolio approach, or in certain cases like what we did in November 23. I uploaded a separate video for the same as well. I'll just share the link if possible, where we discussed the detailed November 23 question 2a, where you had the binomial model being asked and then a risk neutral approach being asked. So a risk neutral probability approach would be using the probabilities, whereas a pure binomial would just mean using the riskless hedge. Now this is a lot more complicated in my opinion, the riskless hedge approach. Risk neutral probabilities is the easier version. If nothing is given, if I were to solve a paper and if I just have to find the option value, I would do that using the risk neutral probabilities. Now what does this approach say? The second approach says there are two possibilities. Let the probability of an up move be P, let the probability of down move be 1 minus P. So the value of a share today, which is 50, is going to be the present value of future possible share prices. That can either be 70 or it can be 30. So basically your price today, that is 50, will be based on 70 into P plus 30 into 1 minus P. But these are prices after 1 year. So this is into 1 plus 0.10, assuming a simple interest application, annual compounding. So this is 50 into 1.1 equals 70p plus 30 minus 30p. Therefore, over here 55 will equal, or 55 minus 30 will equal, I think, 40p, and hence this would be what? 55 minus 30 comes to 25, 25 upon 40 comes to, I think, 0.625. Therefore P is equal to 0.625. Again, there are other direct ways to find P, but this method in my opinion is much more manageable. So this is 0.625. Probabilities. Next, you do 1 minus P, that is 1 minus 0.625, and hence if you do this working, this is 0.375. You can find this P using some other method as well, but over here this is very much manageable. So over here, let us say you can take 0.375. So this is, let us say, 0.625 and 0.375. Okay. So as we did earlier, if you had to derive and find a formula to kind of get P, then you can even use these numbers, take P common and try to build up a formula, which is there in the institute material as well. I'll currently stick to this version directly. So over here, this is your probabilities. The value of the call option can directly be calculated as a present value of future possible call payoffs. That is 30 into 0.625 plus 0 into 0.375 divided by 1 plus 0.1. So if you do this, 30 into 0.625 comes to 18.75 plus 0 upon 1.1. If I solve this, this is around 17.5 0.04 or 0.5 as the case maybe. If you go to see, this is exactly the same. So will they give you the same values? Answer is yes. You can even refer the November 23 solution for this, which is recently done and also a lot discussed. Both of these methods have been done, and this is how you should be solving. There is a third replicating portfolio approach as well, where you can possibly take a position where you take the shares and the borrowing in order to create portfolios which replicates or mimics the payable of the call option, which is very much a permissible method. You can Google up and find a lot of articles on that. There are other methods as well, but if I just want to clear out the confusion and focus on what the institute does, institute focuses on these two methods, at least in the study material, and hence if it comes to that, you will take either of these methods. If nothing is given, risk neutral probabilities. If the question gives you specific information regarding a delta hedge portfolio or a portfolio comprising of shares and options, then the riskless hedge. If they just say binomial method and also say measure using risk neutral like they did in November 23, the binomial method you do using the riskless hedge approach, and the other risk neutral probabilities will be used for the risk neutral approach. Okay, so this is your entire working. I hope that is a bit clear. You have a lot of theory for all of these points. We have mentioned kind of the various steps that you can follow. Special cases over here would come in case of a multi-period question, which is a sum that we are going to practice. A multi-period question, what do you do? If nothing is given, we assume that the option valuation is a European option valuation, and European options can be exercised at expiry only. So here you will solve from the right hand side. So you will try to find the option values at the rightmost nodes. Over here, for example, if this was 2 years, then further there would be further payoffs. So here we will not calculate the call option directly. We will find the option value at the rightmost nodes, and from there try to slowly come towards today's option value. So that is for a multi-period binomial. There is some theory given over here, but best understood with, let us say, a numerical. And what if there is an American option? Well, if there's an American option, then for that American option, the exercise can happen at each intermediate node or the initial node and not just at expiry, and hence the workings might be slightly different for the American option. An additional layer of comparison should be done at each level to figure out whether it is worthwhile to exercise immediately or to wait for a future date. Okay, so I'll try to probably explain this, both of these, with an example, with a numerical. There can also be a put option valuation, and there can be call put parity theory. But before that, let us just try to mix this with numbers so that we kind of make sense of it. So over here, we go to a question number 6, let us say. We'll do question number 5 as well. But let us say first, we are discussing binomial. Let us finish question number 6. Okay, so consider a stock which is quoted at 84. So this is your spot price today as 0. A call option is available at a strike price of 87.5. So this is like your XP. The stock can take a values of 89 or 79 in 3 months. If it takes a value of 89, it can go either to 94 or 84 in 3 months. And if it takes a value of 79 after 3 months, it can either go to 84 or 74 over the next 3 months. So there are multi-period binomial. The stock is not expected to pay any dividend. It is given that the risk-free rate is 4%, unless given otherwise it is 4% per annum. Find the price of the call option using the binomial model. Acha, if the question just says like this, we can even, or we should rather, use the risk neutral probabilities approach, which is the easiest. So in multi-period questions, follow. And institute has also almost always done the risk neutral probabilities approach only. It is only in a single period binomial that they are experimenting with various methods. Multi-period binomial is almost always been at the probability approach only. And using the value of the put option, verify the call put parity theory. So in this case, what do you do? Well, you first drop the binomial tree. So when we drop the binomial tree, how will the binomial tree look like? Well, we will say that the spot price today is, for example, 80, what was it? The spot price today was 84. Let us say the exercise price today was around 87.5. The rate of interest is 4% per annum, and the time frame seems to be 2 years. You go to the two possibilities of an up move or a down move. If the price goes up, it can go up from 84 to probably 89, or it can go down to around 79. So this is 84, say 89, and then it can go down to 79. So your natural temptation over here would be to find a call option value at this level. You will not do that. In fact, you will go further and you will say, going forward, the spot price may further go up from 89 to 94, or can go down from 89 to 84. further go up from uh, let us say 79 to 84 and go down to let us say 74. Now is there any further things? Answer is no, in which case you can try to find the option value as we said at the rightmost nodes. We will say that okay, if this is expiry at this particular case, if the call option were to be exercised, will it be exercised? Well yes, in which case 94 minus 87.5 which will be 6.5 will be the payoff that you will get. In all the other cases, the option will kind of lapse because the exercise price is around 87.5 and hence the option will lapse. So how will you find the value of the call option today? Well, it is considering all the future possibilities. There are 4 possibilities and we have tried to outline that. But then you don't directly come from year 2 to year 0. You come from year 2 to year 1 where we say, okay, then what should be the value at the end of year 1? So we say, well, you know what, let me put this as a single independent question. Over here, if we want, we can find the probabilities of an up move and the probabilities of a down move. So we can say that the price after 1 year is, let us say 89, and 89 equals 94p plus let us say 84 into 1 minus p, the entire thing upon 1.04. So if you do this working, let's say directly 89 into 1.04 equals, the price is 89, right? Okay, 89, is this quarterly? Just a second now. Where is this question again? Okay, this was question number 6. It was after 3 months. So this is 3 months. It is not a 2-year option. It is a 6-month option of 3 months each. So this is 4% per annum is 1% for 3 months. So this is 89.89 equals 94p plus 84 minus 84p, and therefore if you subtract 89.89 minus 84, this is 5.89 equals 10p. Therefore p is equal to 0.589, and therefore 1 minus p, if you calculate 1 minus 0.589 will come to 0.411. So over here these are the probabilities, and if I were to find the value of the call option at year 1, I would say that, well, 6.5 there is a chance of 0.589 that this event will happen, and 0 there is a chance of 0.411 that event will happen. However, all of this will happen after 3 months, and hence if I were to do 6.5 into 0.589 plus 0, so this is 3.83 approximately divided by 1.01, and you get 3.79. So this will be the option value. If this is a European option, we will say that you cannot exercise this option at the end of year 1, and hence the value of this option at the end of year, sorry, not year 1, after 3 months, the value of this option will be 3.79. At this stage, if this was an American option, you would have compared 3.79 with the possibility of an immediate exercise. So if you immediately exercise, you'll probably get 89 minus 87.5, that is 1.5. Will you exercise? Well, no. I'll hold it, because if I hold it, there's a possibility of around 3.79 value. If I exercise it today, I'll get just 1.5. So higher of the two will be the value if in case it comes for an American option. Now, honestly, over here you need to find the probabilities even at these two levels. However, ultimately the value is 0, and hence whatever be the probabilities, the value of this option probability weighted has to be 0. Now you want to find the value today, which means again you need to do p and 1 minus p, and you need to do the same working. That is probably 84 today is equal to 89 into p plus 79 into 1 minus p, the entire term upon 1.01. You do some math and you will get the answer. So probably if I were to just directly refer to these answers over here, this will come to a probability of 0.584 and 0.416. You can do this working, but this is, let us say, 0.584, 0.416, and if you want to find the option value, you will say that okay, 3.79, the possibility of this event happening is 0.584, 0 rupees, this event happening is 0.416 upon 1.01, and if you solve this, this is 3.79 into 0.584 upon 1.01, and your answer should be around 2.19. So this will be the premium that you should be prepared for a call option. Okay, so if you verify this at the end, you will see that this is 2.19, the value for a call option. if the question says you try to find the value of a put option, everything else remains the same. You will make the same chart, just that instead of call option, you will take the put option. But put option is measured the other way around. That is, if the price actually turns up to be 94 and the exercise price is 87.5, I will not exercise the put option. You heard it right. I will not exercise the put option because it's a right to sell. Given a choice, I'll sell at 94 and not at 87.5. But call option I will, because given a choice, I will buy at 87.5 rather than buying at 94. So over here in the put option, if I again start with the rightmost nodes, my put option value will be 0. But later, if the price is 84, I would exercise, in which case I'll get 3.5. If the price is 79, I'll definitely exercise and I'll probably get 79 minus 87.5, that is around 8.5. So if I go to see these workings, this is 0, 3.5, 3.5, 13.5. Sorry, this was 74, so 74 minus 87.5, and this is 13.5. Now you have already calculated the probabilities earlier, so let us assume you had calculated all of these probabilities earlier. If you have already calculated the probabilities earlier, then you can apply those same methods. Like you will say that, okay, how did you calculate this 1.43? 1.43 would be 0 into 0.589 plus you will have 3.5 into, let us say, 0.411, but this value will be after 3 months, so 1.01. If you do this, you will get 1.43. Similarly, 3.5 into 0.579, 13.5 into 0.421 and discounted, and you will get 7.63. At this point, if this was an American option, I would say that if I hold this option, I will get 7.63. However, if I were to exercise that, if it was an American option, I can sell at 87.5 when the price is 79, and hence I can get a cool 8.5 instead of 7.63. And in case of an American option, instead of 7.63, I will write 8.5 over here, let us say. This is a quick discussion. I hope once you practice, you'll get a better understanding. But I'm just trying to give you the entire picture, even if this was an American option. And then the same process you will follow to get the value of the put option today. Now, once you are able to do that, you have found the value of call and put option. Now there is a very important theory that is there which can help you find the value of the put option without doing all of these calculations as well, which is called as a call put parity theory. So what is the call put parity theory? Says that if I were to buy the share today and also buy a put option, S0 plus P0, if I were to buy a share, if I have a share, I can sell that share and hence share comes along with the put option. Or if I were to buy a call option, but call option is a right to buy. If it is a right to buy, I need money. So probably if I invest this money in a bond or in a deposit, today how much should I invest? Well, the present value of exercise price. Now we have done the derivation and the explanation for this in our class, but from an exam perspective, remember that these positions will give you, no matter what prices you take after 1 year, these positions will give you the exact same values at all prices after 1 year or after an next period. So the understanding over here is, if these two positions, this is position 1, this is position 2, if these positions are giving me equal value, let us say after an X time period, they should also have an equal value today. And hence the call put parity theory, among other things, on a simplified basis, says that on one hand, if you have a share along with a put option, on the other hand, you have the call option along with the present value of exercise price, these numbers have to equate. And hence, you can see the valuation of put option using the entire binomial. But even if I did not do that, let us say I do not know the value of the put option, and if I wanted to find using the call put parity, I would have said, okay, put option will be C0 plus the present value of the exercise price minus, let us say, S0. We take S0 on the other side, call put parity theory. So call option value we have derived at 2.19. The present value of exercise price, this is 87.5, discounted by 1.01 2 times. So it's approximately 4% per annum, that is around 2% simplistically over 6 months, minus S0, which is around 84. So if I were to do this, this is 2.19 plus, let's say, 1.01 into equal to, that is 1.0201. So 87.5 upon 1.0201 will be around 85.78 minus 84. So 2.19 plus 85.78 minus 84, and you will get around 3.97. So using such a small working, you can directly get 3.97. If I were to look at the printed solution over here, this entire working you do for the put option and then ultimately come to 3.97, you can save a hell lot of time in your exams by directly using the call put parity theory and find the value of the put option if it is asked. This technique is especially helpful in cases like Black and Scholes model, where the calculation and valuation might get very taxing, and hence you can directly apply the call put parity theory and come to this value of the put option as well. So over here we have even discussed what is the multi-period binomial. Basically you start from the right hand side and slowly come to the value today. We have also discussed what happens in case of an American option. Then at each point you also compare the value that you get with the possible value for an immediate exercise. Put option valuation, you follow the same process, just that the payoff will be based on XP minus S rather than S minus XP. And then call put parity theory, on one side share along with the right to sell that share, and call along with the money to exercise and buy that. Both of them will give you an equal position, and this can be used. The call put parity theory is based on the understanding that positions are always going to be same after 1 year. The amount invested in this position today should also be the same to ensure that there is no arbitrage possibility. For exam reference, in case the value of both call and put are asked in the question, we can solve for call option using binomial or Black-Scholes model depending on the data, and then directly calculate the value of the put option using the call put parity theory. Okay, so over here, before we go to Black-Scholes, there was one more question. If time permits, we can just discuss that in order. So over here there is a question number 5, which can help you in certain cases to calculate payoff as well as to calculate intrinsic value to the extent that data is available. So over here, if you look at question number 5, it's a manageable question, I would say, but nevertheless, X baking company's equity share has a present market price of rupees 28. A 6-month call option has been written on the stock and the exercise price is 30. Presently, the option has a market value of 3. This is a premium that you have to pay for this option, that is 3. And at the end of 6 months, you estimate that the market price of the stock to be rupees 24 per share with a probability of 0.1. 28 with a probability of 0.2, 32 with a probability of 0.4, 37 with a probability of 0.2, and 43 with a probability of 0.1. For it to be binomial, there has to be only 2 possibilities. Here there are multiple possibilities, and hence we do not say that this is like a binomial. What is the expected value of the share price 6 months hence? So they're just asking you what is the value of the share, which is a probability based weighted average, where you will say that the value should be 24 into 0.1 plus 28 into 0.2 plus 32 into 0.4 plus 37 into 0.2 and 43 into 0.1. So if you do all of this, the expected price of the share comes to, let us say, 32.5. So what if the price of the share actually turns out to be 32.5? What is the expiration value of the option if the expected value of the share price should prevail? So if the expected share price prevails, that is 32.5 is actually the value of the share after 6 months, then what is the value of the option that you are holding? Well, this option gives you a chance to buy the share at 30, whose price after 6 months is going to be 32.5, and hence 32.5 minus 30 and 2.5 will be the possible value of this option. What is the expected value of the option at expiration, assuming that the option is held till this time? Now, point A and B appear to be similar, but in point A, the question very clearly tells you that what will be the value of the share price is actually 32.5. Option B does not tell you, which means there can be 5 possible share prices. It can be 24, it can be 28, it can be 32, it can be 37, and it can be 43. There are 5 possible share prices. At each of these prices, if this price actually prevails, yes, there is a less chance, but if this price prevails of 24, will your option have any value? No, you have a chance to buy it 30. Price is 24, and hence this option has 0 value. At 28, again the option has 0 value, but when it goes to 32, the option has a 2 rupee value, or it goes to 37, the option has a 7 rupee value. Over here it has a 13 rupee value. But what are the chances of each of these events happening? Well, the probabilities, if you go to see, this is 0.1, 0.2, 0.4, 0.2 and 0.1. So I will take the probability based weighted average of these option values. I say that this product is giving me 6 possible payoffs after 6 months. Each of these payoffs have different probabilities, which if I take probability based weighted average, if you do the workings, this will come to 3.5. Now ideally this 3.5 gain will happen after, let us say, 6 months. However, the question does not give me any discount rate or interest rate, and hence it is not possible for me to find the present value. If valuation was asked and rates were given, I would have also taken the present value over here. Presently, what is the theoretical value of the option? Remember, theoretical value of the option or intrinsic value of the option is not based on the expected spot prices. It is based on today's spot price. Today's spot price is 28. minus 30. Ideally, it should be the present value of 30, but I don't have the discount factor, and hence I will have to take 30 directly, and hence the answer comes to negative 2. Can your option have a negative value? No. And hence your option is said to have a 0 intrinsic or a theoretical value, just in case it comes. If the question were to ask you to calculate the possible payoff, for example, if the price actually turns up to be, let us say, any of these, 37, find the payoff. We would have said if the price is 37, the option would be exercised, we will get a payoff of 7 rupees, that is 37 minus 30. If the question further asks you to find the net payoff, we would say, well, 37 is a payoff minus, for example, whatever is the actual market value, the premium of 3 rupees, less that is what you get as the net payoff. So these are the discussions. Generally, you can practice the payoff questions, because if they come, they are very, very scoring. People get scared, intimidated of derivatives. They say, okay, this is very difficult. Whereas, in my opinion, Forex is a lot more complex, has a lot more adjustments as compared to derivatives. Derivatives has some terminology, which is very taxing for a student as a layman, an outsider of a financial market to kind of grasp. But once you are clear with that, short, long, all of this, you should be able to grasp derivatives fairly easily. Well, at least till the time you reach Black and Scholes. Now, Black and Scholes, to the extent, okay, till now what we have done is we have tried to understand the concepts, everything to the extent possible, but Black and Scholes is a fairly taxing formula. For us to kind of get a firm grip of it, well, we can do that, but first we have to secure the exams, and hence we can try to remember a particular formula. Again, from an exam perspective, thankfully you have more sums from binomial coming in your main exams, option payoff type of sums coming in your main exams, and Black and Scholes rarely comes. But that does not mean you leave it, because if it comes, it will be a direct question, and as a result, if a Black Scholes question does end up invariably landing up in your exam, just remember the formula, apply a few steps sequentially, and you should be good to go with Black Scholes model. Practically, this is one of the most important models from a practical standpoint. So basically, Black and Scholes model is something which is numerically quite intense. Let's quickly kind of discuss this. So what is the essential feature of this model, and why is it better, as we say, as compared to the binomial or the intrinsic value method? Because, well, see, the drawback of the intrinsic value method was they did not look at the expected future price. Binomial tried to cover it up by taking possibilities of expected future share prices, but these possibilities of expected future share prices were highly subjective. You did not have a reasonable basis on why these were the actual prices. Well, you were just given that the price goes up from 84 to 89. Why? Why not 89 and why not 95? So there was no objective basis, and hence Black and Scholes use the implied volatility, or let us say for simplicity the deviation, as a base, and devise a formula to incorporate that, use normal distribution values, and somehow try to find the value of option in a fairly more complex and a sophisticated manner. So over here there are 5 ingredients when you go to find the option value. One is the spot price, one is the exercise price, one is the time of the option, next you have the rate of interest, and lastly the deviation, the volatility. And Black and Scholes takes all the 5 into consideration. So how do we know in the exam which method to follow? Well, if the question just says calculate option value and it gives you the standard deviation number or volatility number, you use the Black and Scholes. If the question does not give you the standard deviation or volatility number, but it gives you 2 possible up moves or down moves, in which case you use the binomial method. And the question does not give you either of these, then you can use your theoretical option value for the purpose of your option valuation. So over here there are 5 essential things, as we discussed over here, for the purpose of option valuation. Considering that if you want to find the option value, let us say for a call option, the value today would be S0 into ND1. How do you calculate ND1? We'll see, but S0 into, let us say, ND1 minus present value of the exercise price. So what we are doing is we are essentially taking the theoretical option value as a base, and we are saying, okay, let us take S0 minus XP upon the present value, where the present value over here will be done using continuous compounding at this particular case, because Black Scholes require a continuous compounding method to be applied over here. So this is S0. The only problems over here will be S0 has to be multiplied by a term called as ND1. XP present value has to be multiplied by a term called as ND2. Now how do you calculate that is the entire dilemma over here and the workings. Otherwise, this is the call option value, just that using continuous compounding, but we need to take ND1 and ND2. What is N? that is the normal distribution value of something called as D1, and D2 is the normal distribution value of D2. Now, how do you find these values? There are 5 steps. First, before you go to those steps, we'll just try to understand what D1 is and what D2 is. So, D1 over here is calculated in a slightly more technical way. D1 is calculated as a natural log. This IN or LN over here is the natural log of S0 by XP plus R plus volatility squared divided by 2 into T. So, basically everywhere over here you see a plus sign. If last में into T you are multiplying, and in the denominator the standard deviation into root of T. So, without going into the detailing at this point on why, what, this, you just get these numbers correct, where R is the rate of interest that you calculate in decimal. So, if the rate of interest is 8%, this is 0.08. Standard deviation is also in decimal. So, if it is 22%, it is 0.22 squared. And T is in years, which means if it is 3 months, you will not take 3 months, you will take 3 by 12, that is equal to 0.25. So, these are the small things that you can possibly make a mistake. You can just end up writing 22, or you can end up writing 8, or you can end up writing 3 for months. Actually, it is 3 by 12, that is 0.25 years. And accordingly, you file D1. How will you find the natural log over here, for which we have to dedicate a separate step? So, step 1 is how to find the natural log. Ideally, the institute should give you all of this, because it's more of a mathematical working. In one of the questions they have given you, but otherwise if it is not given, we should know how to calculate this as well. So your step number 1 will always be to calculate the natural log. Then step number 2, use that natural log value to calculate D1 and D2. Step number 3, use that D1 and D2 values to find the normal distribution value of ND1 and ND2 from the normal distribution table. Step number 4, find e raised to RT. So when I look at this formula, in this formula, what are the missing pieces in this puzzle? So over here, first I need to find D1 and D2, but before that I need to find the natural log. So over here, first I find the natural log as S0 by XP. We'll see how to find that. Then we find D1 and D2. This is your step 2. However, that is not enough, because I want the normal distribution value of D1. So I take ND1 and normal distribution value of ND2, so I take D2, and then I need to find e raised to RT. So over here I find e raised to RT, and once I do that, I will end up ultimately substituting all of these in this given formula to find the Black-Scholes value. There are a lot of smaller integrities that you need to remember, like when you calculate the normal distribution value, how do you calculate the normal? See, the first step is to calculate natural log. So for natural log, we will probably take a sum and again understand along with that sum. So let us say question number 7, we'll just focus on sub point 1 for this question so that we understand the Black-Scholes application. Sub point 1. So the shares of TIC are currently priced at 415. So this will be your S0, and the call option is exercisable in 3 months time. So this will be 3 months. So that will be 3 by 12, that is equal to 0.25 will be your T. At an exercise price of 400, so this will be your XP, and the risk-free rate of interest is 5%, so this will be your R, and the standard deviation or the volatility of share prices is 22%. Now this sentence in the question kind of hints that you should solve using Black-Scholes, because the standard deviation of volatility is given. Okay, so this is your standard deviation over here. Assuming there is no dividend over the next 3 months, is the option worth buying for 25? So 25 is a given price, but we need to figure out whether it is worth buying or not. So if I were to do this using Black-Scholes model, first I will say that okay, this is the value, but to apply the formula I need to find the natural log of S0. S0 is today the spot price, which is 415 rupees, upon the exercise price, which is I think 400 rupees. So this would be 415 upon 400. So this will be 415 upon 400 comes to what? 1 point. So this is natural log of 1.0375. Now what do you mean by natural log? Natural log means log to the base e. Usually every log that you find is log to the base 10, but if you want to find, so this number is nothing but log to the base e. So there is a change of base rule that you can apply if you want to change the base to 10, because everything that you study is based on the base of 10. So you can say okay, the log to the base e would be the natural log of 1.0375. So if I were to apply the change of base rule to find this answer, we will say okay, that will include log of 1.0375 to the base 10 upon log of e to the base 10. So there is a concept of log of a by b will equal log of a to the base 10 upon log of b to the base 10. Now e is 2.71828, and if you do the log workings enough number of times, you would know that this log value will be the same, that is 0.4343. So you will take the log in the numerator by that same method of either square rooting it by 19 times, 12 times, 15 times, whatever it is. Find the answer divided by the log of e. Again, you can do the working and find 4343. Otherwise, you can even kind of remember this number. E is 2.71828, log of e is 0.4343, and you will get, let us say, this as 0.01598. So maybe plus or minus certain degree of rounding off, but 0.01598. The thing that you have to resist over here is you have to resist the temptation to take the anti-log. It is so normal that when you take the log, you are usually habituated ke chalo yaar, we will take the anti-log. But remember, what you need to find in D1 number is the log, the natural log of S0 by XP, not the anti-log of that. And as a result, you leave it at 0.0368. The typical place where SE student is making a mistake over here is they end up taking the anti-log, which you should not. The second step is calculating D1. So for D1, natural log, that is 0.0368 is to be taken. Everything is added plus R. R over here will be the percentage per annum number only, which is 5%. So that is 0.05. The volatility over here is 0.22 squared divided by 2 into T, which is 0.25. And you divide this entire term by 0.22 into the root of t. So this is into root of 0.25. And if you do this calculation, you will end up getting D1. Again, this is a mathematical working. You will end up getting D1 of 0.50 approximately. So over here, D1 is 0.50. But sir, we did not study about D2. Well, D2 is nothing but D1 minus the denominator of D1. So this is into, let us say, standard deviation into the root of t, that is 0.50 minus, if you take the denominator, that is 0.22 into root of 0.25. If you solve this, probably you will get 0.11 and your answer will be 0.39. So this will be your D2. So this is your second step. So when you're looking at this second step, it is a calculation intensive step. And third step is the interesting one, where you have to find the normal distribution values. Now, for the normal distribution values, a few rules have to be remembered. So let us say if you want to find ND1, that is n of 0.50. So you will say that, okay, this is a normal distribution chart. Center over here of this log normal distribution is going to be 0. You are interested in finding the area from the left tail. So this is your left tail, area from the left tail all the way up to your D1. So if D1 is positive, it will plot on the right hand side like 0.5 over here. If D1 is negative, it will plot on the left hand side of 0. So 0 is at the center of this distribution, and hence your desired area is going to be this entire shaded area. Now out of this shaded area, we know for a fact that normal distribution is evenly distributed, and hence half of this value is 0.5. But then what is the remaining value of this shaded area? Well, depending on the type of the normal distribution table given. So let us say this is the type of a normal distribution table where you are given the area from 0 to, let us say, the point Z, which is D1 in this case. So if you look at 0.5, this value might also be possibly given to you. So this is 0.50. So this is 0.1915. So we can say that this area over here is 0.1915. This area is 0.5. So the total over here will be, let us say, 0.6915. Similarly, if you were to do ND2, this is 0.39. Then your D2, which is still positive 39, will plot on the right hand side, and hence this will still be 0.5 plus 0.39. So this will be 0.3 and 09. So this is 0.1517. So this is 0.1517, and hence this is 0.6517. Remember, if it is plotted on the left hand side and if the table is given in a similar way, you will say that, okay, if for example it was plotted over here on the left hand side, your desired area is still this shaded area, which means if I get the answer, this answer will be, let us say, the answer for this area. Let's say it comes to 0.2. I don't want this area, I want this shaded area. So if this entire area is 0.5 minus 0.2 I can derive, then the remaining 0.3 is my desired area. So this is something where you need to do a little practice and also look at the types of tables that are given. Like this is a table for only half of the value from the mean. There can be a table where the value is given from the left tail all the way up to your desired value, or the table where you are only given the tail value. So you need some practice over here to kind of get a complete hang, but let us say if I were to take this as a base, this would be your values. So your step number 3 will be the normal distribution values, and when you take the normal distribution values, we are told over here that you will, let us say, you will take, while doing this workings, you will take while finding the normal distribution values, we should prepare a normal distribution chart with 0 as a center. We plot D1, D2 on separate charts. If positive, D1, D2 will be plotted on the right. If negative, they will be plotted on the left, and accordingly you will try to figure out the value. Now e raised to r, it is something that you can calculate directly. We have done earlier as well. E raised to r is 0.05 into t. This is 3 by 12. That is e raised to, I think, 0.05 into 3 by 12 comes to e raised to 0.0125. Again, how do you find this? Well, you will say we don't know how to calculate it, so let us take the log on both sides. So over here, log of e raised to 0.0125. So anything a raised to b becomes b log a. So this is into 0.0125. Log e we know is 0.4343. So 0.0125 into 0.4343, and you will get a value which is 0.0125 into 0.4343, and this is, let us say, 0.005 something 54. You will try to find the anti-log of this number. Again, you will divide this by 227695, add 1 into equal to 19 times, or whatever method you do, and you will try to find the anti-log of this number. And as you will see over here, probably your e raised to rt, so nd1, nd2 given, and probably your e raised to rt will come to, let us say, 1.0125. let us say this is given. And now once you have all of these ingredients, S0 today, C0, that is a call option value today, is equal to the S0, which is 415, into ND1, which is 0.6915 minus the exercise price 400 upon 1.0125 into 0.6517. And if you were to solve this, you will get the call option value. Now, as you can see, this is 29.51. As you can see, if this option is available at 25, it is worth buying, because according to us, the value should be 29.51. Now, if you have to do a similar working, let us say for a put option as well, it will become very taxing. So maybe tricks like call put parity theory can possibly help. And if the question asks you, like this question, if you see further, it does ask you, point 2 just says calculate the option based on Black and Scholes if the spot price is 380. Well, instead of 415, it is 380. It is just giving you more practice. So you can try that at 380 and see if you get the answer. Here on the normal distribution, you will probably be plotted on the left side of the center. So you can probably try that. What will be the value of the put option if the price is considered to be 380? Well, in such a case, you will have to take the call put parity theory. You can say P0 plus S0. S0 over here is, let us say, 380. P0 we don't know, equals to C0, whatever is the call option premium, plus the present value of exercise price. So the present value of 400, and you can find the put option value. This is exactly how even the working has been done over here. Using the call put parity theory, you have applied this and found the answer of the put option as around 25. The last possible complexity that can come over here is the possibility of a dividend. In point 4, they have said that what if there was a dividend? Remember, the fundamental remains the same. If dividend is there, dividend is going to be received by the spot holder, not by a person who is getting the share after 3 months, and hence dividend will be deducted. But premium is to be paid today, and as a result, while doing option valuation, we don't take everything to a future date, we bring everything today. So we will take S0 into ND1 minus so when you do this S0, you will subtract the dividend. You will take the ex dividend price. For simplicity, you will take the ex dividend price, subtract the present value of dividend, also using continuous compounding. If you want to practice, you can see over here, we have actually done that in sub point 4. So you will take, in case the dividend is paid before expiry of the call option, instead of taking the spot price directly, we take the ex dividend price, that is adjusted as 0, which is S0 minus the present value of dividend. That's it. And everywhere that you take, instead of S0, you will take the adjusted S0, and you should be done. Now, Black and Scholes is something which I would not say that you will understand it the moment you listen to it. You will have to do some practice, toil a little, but if it comes, it will come exactly on these lines only. So that is your bonus. And that nervousness that okay, I don't know, that will not happen. You just have to practice 2 full questions. Trust me, 2 full questions. Make mistakes twice while you're doing those 2 questions, and the third question will not make the mistake. It is just a numerically intense question, and that is it. Do 2 full questions on pen and paper. First question you make a mistake, second question you improvise on those mistakes, and third question you will not go wrong. So this is regarding Black-Scholes model. Then there is something called as option Greeks. Now option Greeks, it is there in the theory. There are no specific sums dedicated, it is in the institute material over here. But being Greeks, I do believe that there can be a possible MCQ question pertaining to this. So because these are terms, it's classic MCQ, that delta, vega, theta, gamma, rho, what do these terms mean? So option Greeks are like studying the features of an option. So how does an option premium or option value respond to a particular change in a particular fundamental factor, everything else remaining constant? Again, how will an option premium, option value is option premium, how will an option value or an option premium react to a change in a particular fundamental factor, all else remaining constant? So over here, why should an option premium change? Well, there are 5 essential ingredients. Spot. Can the spot change? Well, yes. So any change in the option premium in response to a spot price change is measured by something called as delta. In my opinion, the most important among the option Greeks is delta. How much will a premium change in response to a 1 rupee change in the shares price? Second is the exercise price, but the exercise price is fixed, it does not change, and as a result we don't need to study anything for that. Third, you have something called as volatility. Now if your stock suddenly becomes more volatile, like in Adani, Hindenburg gave a report and the Adani stock became a lot of volatile, which increases the risk, and hence if standard deviation or volatility changes, then the option premium would change. So what is the impact of a change in volatility from 22%, let us say, to 23%, all else remaining constant? What is the impact on the premium? This is measured by something called as vega. V for volatility, V for vega. Fourth is the time to mature. So over here, as the option, the longer the period, the more the risk, the shorter the period, lesser the risk. So as time passes, let us say if it is a 3-month option, it now becomes 2 months, it then becomes 1 month, and so on. So as time changes, does the options premium change? Well, yes. Like if you take an insurance contract for 12 months versus take it for 11 months, the premium would be different. And as a result, the change in the premium due to mere passage of time, all else remaining constant, is measured by something called as theta. T for theta, T for time. Next, you have rho. The 5th factor was rate of interest. Rate of interest changes, and since the option value is a present value, there might be a slight impact on the change in the option premium due to a change in the rate of interest. This is measured by something called as rho, RHO. So basically, delta measures the responsiveness to share price movements. Vega measures the responsiveness to volatility, that is the standard deviation. Theta measures the responsiveness to time, and rho measures the responsiveness to rate of interest. Further, there is one more metric called as gamma. The most important of these parameters in general is treated to be the underlying spot price. So as the spot price changes, the option premium would change, and that change is measured by delta. But the problem is that delta itself also keeps on changing. So the rate at which delta changes is called as gamma. Now this is a little complicated to understand, but if you have a decent understanding of, in bonds, you have Macquarie duration and you have convexity. What was Macquarie duration? Macquarie duration measures the responsiveness of changes in bonds price in response to changes in interest rates. But the problem is the Macquarie duration itself can keep on changing. So convexity used to measure the rate of change of Macquarie duration. So gamma is in a way similar to that. Delta measures the responsiveness to changes in prices. However, prices can keep on changing, and in response to that, the delta itself can keep on changing. So that is what the gamma measures. So delta is the responsiveness to short spot price, gamma is the movement in delta, vega is volatility, theta is time, and rho is the rate of interest. So over here, you may not necessarily get full-fledged questions. We did practice a couple of questions, I think, in class, but you may not necessarily get these full-fledged questions. If you do, then you can apply those, but otherwise it is relatively less important. The only thing that you might be asked is to calculate the position delta or position gamma. In that case, all you have to do is you have to find the number of products into the contract size. So if there are 10 option contracts that you have bought, if you have long, you are going to have a positive position. If you are short, you show it in bracket, that is negative position. Every option has 100 shares, so 10 into 100 into whatever delta, gamma, vega, all of that together will give you the position delta if it is asked. But otherwise, you might also be asked to create what is called as a delta neutral portfolio, in which case the delta of your overall position should be 0. Gamma neutral portfolio means the gamma should be 0, and so on. But I would not read too much into this because this is not as relevant if you are just revising before your exams. Just having this brief understanding from an MCQ perspective, I think should kind of help you. So that kind of largely takes care of derivatives. There are a few additional theory concepts which are added where they have kind of given you, but that does not really impact the numbers per se of different types of theory, things like a credit default swap or a CDO, CLO, etc. There's a separate theory section for that which we have shared separately, so you can refer that at least on the PDF format or even videos if that is there. And also for real options. So there is one more thing which is largely linked to capital budgeting as well as derivatives, which is on real options. Now real options are nothing but options on, let us say, capital budgeting projects. Like if you have a project and you want to abandon that project at a later date, an abandonment option or a growth option or something else. So there are 3 particular examples or illustrations that the institute has given. I will try to put a video separately for these 3 products, 3 options. As of now, till further clarity emerges, it is best if you just look at the construction to the extent possible, and wherever possible we have tried to explain the reason, rationale of why a particular change is happening in case of those abandonment options. But at least if your exam is nearby, let's say May, November 24, etc., then unless the institute brings out any further clarifications or changes, if it comes on real options, these are the 3 illustrations that you should refer. We will solve that separately. Try to remember to the extent possible the workings. If not, you can probably just go with the flow and at least understand the 3 illustrations and proceed further. So I think for this course section of derivatives, I will kind of stop for now. We will share real options also separately, but I hope this entire discussion has been helpful. Keep on studying hard. I'll see you soon with some other videos as well. Till then, goodbye, take care, and all the best for your preparations.